Welcome back, investors, to Ticker Time News. I'm Adam, and one sentence in this policy directive today from the Fed caused the market to rally, and one sentence from Jerome Powell's press conference to cause the market to fall. What a wild day, right? Well, here's the couple of sentences. I'll explain them, what the Fed said in the directive that they released at 2 p.m. and at Jerome Powell's press conference at 2:30 p.m. I'll tell you what happened, why it happened, and why the market did this crazy rally then fall. I think there's more falling today. More falling tomorrow to come. Yes, what an insane day. That is a perfect way to sum it up. Let's pop it up here on the screen. Let everybody see. Insane, right? Okay, so I'll answer those questions in just a moment. But first, let's get this all into perspective and what happened, right? It shaped up to be a rough day on the market, but it wasn't always that way. If you would have missed this morning, you would have missed a boring session in the market. The market pretty much went nowhere. It was in a very narrow trading range, but it ended with some losses, and some pretty heavy losses, almost 3.5% on the Qs. That's pretty bad. Now, the FOMC meeting was today from the Fed, and the policy decision or the directive came out at 2 p.m. when stocks took a sharp turn higher. There was a misunderstanding with that directive, and that's why the markets went higher right after the press release came out. Things quickly deteriorated, however, as Fed Chair Powell gave his press conference at 2:30 p.m. Eastern. Ultimately, the major indices closed at session lows. This is the 5-minute chart here for the S&P 500, ticker symbol SPX. And you can see all of the action took place in the latter half of the day after 2 p.m. Eastern. This morning, boring, flat, barely moved, maybe down a little bit right before the policy directive came out. Spike and then a sell-off, and there's a couple hesitations on the way down, and it's because Jerome Powell said a couple of things that maybe could have been interpreted as a bit dovish, but the overall message was very, very hawkish, way more hawkish than the market had anticipated. Now, the initial push higher after the policy decision, I've got some nerves still built up in me about today because it was just, whoa, crazy. Now, this directive, which fueled the market's hope for a less aggressive rate hike approach at the December meeting and the January meeting, came down to this line, quote, "In determining the pace of future increases in the target range, the committee will take into account the tightening of its monetary policy on a holistic approach." And this is the key word right here, the lags, keep that one in mind, lags with monetary policy affects economic activity and inflation and economic and financial developments. That word lag was brand new. That word lag got the market thinking, oh my goodness, we're definitely going down in the amount that the interest rate or Fed funds rate is going to be raised. Well, no. When Fed Chair Powell came out, he corrected not the word, but he added context to that word lag. We all know that the CPI data is a lagging indicator. All the information that comes through CPI is taken place months ago, right? When we finally get those CPI readings and we see that inflation is at 8.2% or core inflation is at 6.2%, that's because of prices going up a couple months ago, right? That's a lagging effect. And that word lag got the market all hot and heavy, and it rallied. Now, the wind got knocked out of the market sails after Mr. Powell emphasized that the Fed still has a long ways to go with the policy rate to a restrictive level. Let's get clear on what restrictive means? It means the Fed funds rate is going closer to 5%, and then the Fed is going to do something it does not normally do, and it's going to hold that restrictive rate. Okay, that 5%. It's going to get real close to that 5% rate come January, and then the Fed is going to do a little pause or a little slowdown, but it's going to hold at those high rates. The market is not prepared for the Fed to hold the interest rates high. And that's what the word restrictive means. So the policy rate to a restrictive level and hold. Pause. Take a minute to slow this economy down. And then he added at the press conference, quote, "It is very premature to be thinking about pausing." It's premature to be thinking about pausing. What did we talk about leading up to the FOMC meeting? We talked about there will be no pivot. There will be no pause. There may be a slowdown. That's what we were thinking going into this meeting. And that's the message I've been sharing for the past several live streams, that maybe we could not pause. Let me get my words straight here. We could slow down in policy rates come December. Instead of another 75 basis point rate hike in December, maybe we would get a slowdown to 50 basis points. But the word pause and the word pivot, Mr. Powell was very careful to get the message across that there will be no pausing, there will be no pivoting anytime soon. It is premature to even start thinking about pausing. The market's not ready for that. Another rough point for the market was when Jerome Powell, in his messaging, that incoming data since the last meeting suggests the ultimate level of interest rates will be higher than previously expected. And that, again, quote here, "There is more ground to cover," end quote, before it meets the test of being at a restrictive level. So what Jerome Powell revealed today in his press conference that got the market to sell off was that where the Fed during their September meeting thought they would have to go with rate hikes, maybe 4 to 4.5%, is not far enough. They're going to have to go closer to 5% now before they even start to think about pausing. The market was not prepared for that and is still not prepared for that. And that's why the market sold off. So we got to get the vocabulary and the meaning of these vocabulary words in order and understood to know where the market's going to go next and where the Fed is going to go next. So we've said this before. We've got slowdown, we've got pause, and we've got pivot. Slow down, pause, and pivot. We are nowhere near pivoting. That's when they stop hiking rates and they start to lower rates. We're nowhere near that. And then we have pause, where the Fed goes from hiking rates to holding rates still. Okay? Not going up anymore and not going down. That's a pause. A slowdown is when they go 75 basis points to maybe 50 basis points at the next meeting. So as long as we are clear on those three vocabulary words and those three meanings, we should understand where the Fed is going and where the market is going. Now, sellers, they stepped in once they understood that the Fed has got to go higher than they thought they needed to back in September. That's when sellers stepped in both the Treasury market and the equity markets. And this was during and after the press conference. The 2-year yield Let's pull that up real quick, and then we'll come back. I'm going to go to the daily view, and I know I'm saying a lot here, and I'm not showing a lot on the screen, and that's because there was a lot said today that I can't really demonstrate with a picture here on the screen or a chart. So let's open this up a little bit, and we're going to go to the 2-year so I can show you what it did, and then we'll go through the SPX, the SPY, the Qs, the IWM, the MDY. I don't want to forget mid caps here, but just look here real quick. The right-hand side of the screen, look at this big red candle for today, okay? Right there. What I'm going to do is I'm going to place an anchored VWAP, okay, right here on today. All right. It's been attached. It won't show up until we start moving forward in time. Remember, we have and let me just point this out here on the chart, and then we'll go to the 2-year. We have an anchored VWAP, these black lines that you see converging right here above this blue line. Those two black lines converging are two things. Number one, it's an anchored VWAP that's anchored to this candle underneath my blue highlighter right there. That was the last FOMC meeting, September the 21st. And then there's another anchor right here, another anchor VWAP above this blue highlighter. And that's attached to October the 3rd, which was the beginning of the quarter. All right. So we now have these two black lines, the last FOMC meeting and the beginning of the quarter converging right here at about 37.25. That will be a support level as this market continues to fall. So that's something that we'll have to pay attention to the closer we get to it. We're not that far off. We closed at 37.59, not that far off, but we'll talk about that in just a moment. Let's get through going back to the 2-year here. And I just placed that third anchored VWAP for today. But again, that'll show up later as we move forward in time. US 02Y for the 2-year. Now, initially, the 2-year traded down to 4.44%, but it settled the day at 4.55%, and then it jumped to 4.62% after the close of the cash session. Now, the Treasury market, it's not on the same hours as the equity markets. The Treasury closes earlier than the equity market does, okay? So at 4 p.m. Eastern, when the equity market closes, the cash market for the Treasury market has already closed. So this extra, nearly 8% or so jump after the cash session closed in the Treasury market, that's a big deal. That normally doesn't happen. And now we have the 2-year pushing back up here, testing this recent high on the 21st of October. And that is currently 4.61% where it sits right this moment. That high was at 4.63%. So we are 0.2% away from that high a few sessions ago. And when we closed, we were only 0.1% away from that high. So we are going to test that again, it looks like tomorrow. Now, the 10-year, that looked a little bit different, but kind of the same, right? US 10Y for the 10-year on TradingView. There is a link in the description to TradingView if you don't have an account. It's simple, it's easy, and it's free to set up an account. Now, the 10-year, it fell to 3.98%, but it settled the day at 4.06%. But then it jumped after the close of the Treasury's cash session to 4.11%. It is currently sitting right now at we can call it 10% by rounding up. Now, for the 10-year, there is this red line right here. My highlighter is pointing to it, right? That red line is significant. It has been an area of resistance right here for the 10-year. Can it hold, or are we going to start marching back up to try to test this all-time high sitting up here at about 4.33% tomorrow? I think we're going to go back up and try to retest that high in the coming sessions. Now, with the 10-year going up, with the 2-year going up, what's that going to do to equity markets? That's going to put pressure on the equity markets. That's going to put selling pressure on the equity markets. Now, stocks today, when they sold off, it was sold off in a very broad fashion. Let me open up the sectors here so you can take a look at those. The right side of the screen, all those percentage points right there. I'll stop it there. Those are your 11 sectors down big. It looks like we've got a spread here. First, all 11 closed with losses, and some substantial losses ranging from 1% utilities, XLU, to 3.8% for consumer discretionary, XLY. That's a big fall. That's a big fall. So very broad-based. There's a lot of 1% to 2%. Oh my gosh, there's even 2.8, 2.4, 2.6. Wow. Just a crushing day all around. But one place that things just happen to fall even more were mega cap stocks. They suffered heavier losses than the broader market. And we can tell by looking at the Vanguard Mega Cap Growth ETF. The ticker symbol is MGK. Let's pull that up here so we can look at it. It fell 3.6% today versus the 2.5% loss in the S&P 500 or the SPY. Look at this. Gigantic fall. Now, ignore the purple lines. Those are weekly expected moves, but they're not updated yet. Let me close this. Now, one thing that is kind of stunning, right? With mega caps falling today like they did, more so than the broader market, well, mega caps, they've been on a roller coaster ride recently, right? Think of all the earnings reports from the Alphabets to the Microsofts to the Apples to the Meta platforms and the mixed results we've gotten there. Some better than others, right? Meta platforms just continues to lose. Can it even be considered a mega cap growth anymore? I'm not really sure. But they got hit hard, and they also got hit hard yesterday. The Qs, for example, they've been hit really hard, and that caught me a little bit off guard. I'll be honest with you. I did not expect the Qs to underperform like they have, but these big mega cap stocks, their earnings haven't been so great, right? We'll dig into earnings tomorrow because I've got some new data on earnings thus far that show if you take out oil, if you take out energy from the earnings reports that have been reported so far this earnings season, we're actually at a loss. So yeah, we'll talk about that tomorrow. I want today to be more about the Fed. Didn't Powell, let me pull this up on the screen so we can all see it here. Okay, there we go. Didn't Powell also say that he's not afraid of breaking something? In a way, right? He's not going to say that directly, right? But he is willing to hike rates as far as necessary. Again, using the data to drive their decision. And Powell did say that maybe within the next 2 meetings, they will start the discussion of maybe slowing down interest rates. But he did say, and I can remember this from his conference because it was like a bell went off. I had several bells go off during his press conference. That word lagging in the press release, the directive, that was a light bulb because that was new. That has not been said before. Also, Powell talking about taking rates higher than they thought just a month ago. I'm sorry, the last meeting in September, because remember, there was not an FOMC meeting in October. So the meeting in September to today, things changed so drastically that now the Fed thinks they are going to hike rates higher than they had previously thought. That's going to take us closer to 5% at the Fed funds rate. What do you think that's going to do to a mortgage rate? Take it to 10% plus, right? 10% or higher for a mortgage rate by the time we get to a 5% Fed funds rate. So, yes, he is willing to take the interest rate to a restrictive area to slow growth and to force unemployment to go up. And he's not afraid to hold it there. Now, we'll see what political pressure gets put on him once they reach that point to see how long they actually are able to hold it at a restrictive rate. But you are right. Yeah, energy and Apple have done the heavy lifting. You are absolutely correct. Energy has been just nailing it. And this windfall tax, man, I don't know how you guys feel about it, but do you remember during 2020, the energy industry was losing millions of dollars. Now they are profiting and the government wants to tax them on windfall profits, right? I don't think that's right, because when the energy industry is suffering, is the government going to come in and start bailing them out? Because that would be the opposite of a windfall tax, right? And I don't think that's right. Let the open market deal with it, not the government. The government, get your hands out of our pockets. Yes. Okay. So we'll talk about the earnings thus far on tomorrow's live stream. I want to keep it focused on the Fed here. Now, and your questions too. So if you have a question, plug them in. I'd be happy to hear about them and answer them the best that I can. Now, on an individual level, there were a few names that bucked the trend today. Quarterly results from CVS up 2.3%, Match Group up 4.2%, and Mandela's International, they were up 1.2%. They were among some of the winning standouts today, so don't think it was all doom and gloom. There were some winning companies out there in the markets, and it mainly had to do with their earnings reports. Now, energy complex futures, they settled the session higher. Let's look at oil. U.S. oil. Get my cursor back on the screen here. U.S. oil. WTI crude oil futures rose 1.6% today to $89.82 a barrel, and natural gas rose nearly 7%. It's now out of the fives and into the 659 or so area. Yeah, so energy is rising. Now, let me clear this chart up just a little bit here, get a bigger picture, because oil has definitely come off, but it is rising. And it's in this chop box, this yellow chop box here. This is where oil has been going back to August 1st. So if you really think about it, besides this one dip right here in oil, that was the end of September, oil has basically been chopping around in that yellow box. And this is that little dip right here at the end of September. So oil now is on this trajectory like this, okay? And I do think it is going to push higher. And I do think this 200-day moving average that's coming across like this, I think they're going to end up meeting. If I left this circle which is a horrible circle, by the way. There we go. I think energy is going to come up here. I think it's going to get real close to that $100 a barrel the deeper we get into winter. The deeper we get into winter, the closer we're going to get to $100 a barrel again. That's what I'm feeling right now. And the reason I'm feeling that has to do with two things. One, Europe. Two, China. If China is going to reopen, okay, like it's doing, it's going to, right now, it's buying from Russia, refining it to diesels, gasolines, other things, and then selling it to Europe. Once China starts to open up a little bit, then we're going to get China keeping that oil, refining it, and then keeping it for themselves and not selling it to Europe. That's going to create some pressure for the price of oil. Okay. So I do believe we're going to go back up to that $100 a barrel the deeper we get into winter, unfortunately. But I think that's where it's going. Let's see here. Are oil companies still getting subsidies? Why? Okay, great question. Let's do this. I'm going to keep this chart on the daily, but we're going to go back in time here, okay? We're going to go back to, I believe there's two answers to this if my memory serves me correctly. We need to go back to 2020, and you can see the oil has come a long way since then. All right, we've got that 2020 dip on there. So if we were to put a line on oil, let's just put it about right here. All right, come on, highlighter. There we go. Let's just put it right here. And then if we ran that across, it would come to about this level. And if we kept running, all right, so $60 a barrel. Let's say that's the average, right? Well, from February 2020, okay, we had that steep fall. Remember, oil actually went negative, right? Oil went negative. And then we had this kind of rapid rise here. It kind of hung around before finally going back up and getting to that $60 a barrel. And that was February 2021. So for an entire year, right here, oil companies were losing big time, right? And I do believe the government helped out at that point, right? That's what I believe. And I believe that it was due to the fact that oil turned negative and the government stepped in, just like the government stepped in everywhere. The other part of this is I do believe there's subsidies on the renewable side of some of the energy companies. And of course, the reason there is because they're putting tons of money into research, development, and renewables that are not returning any profits yet. The government wants to speed that process up, so they are subsidizing, kind of like Tesla gets those subsidies, or those tax credits, right? So I believe those are the two of the reasons. There could be more, and I'm not completely 100% sure when it comes to the subsidies. I'm just thinking about this windfall tax that they keep talking about right now. And if you look at a chart of energy companies and how profitable they've been over the past 50 years, it doesn't look as greedy as you might think it does. I cannot remember where I saw the chart, and it was recently, within the past couple of days, of energy companies and their profits. Their profits this year are like, let's use this blue line on the screen right here and say this is the break-even line, right? So profits were like, up here, they were, down here, they were up here. You get to this year and profits are like this. And of course, the highlighter didn't follow me. You get to this year, let's rewind that and do it. Profits are like this. I can't believe the highlighter doesn't want to do it. Okay, let's try that one more time. I'll go down this time. Okay, there we go. you get to this year, and this is what profits look like compared to what profits have been on average for the oil companies. And there are several years on that chart where they actually produced losses on their balance sheet. So it's an interesting chart to look at. Maybe I'll try to dig it up for tomorrow's live stream, and we can talk about that a little bit. But I just think the windfall tax, I think it's a little too much. I really do. Not saying it's completely wrong, but I do think it's a little too much. I think it's more political posturing, honestly. But I don't want to get into politics. We're talking about finance and money here, so I'll keep that part clean and out of it. All right, let's hop back into this. Let me tell you what's coming up tomorrow, and then we'll go through the major indices here and talk about where they're going, what they're doing. All right, let's pull this back up. Tomorrow, there's a few things that we get tomorrow that could play a little role in the markets. Obviously, digesting what the Fed did today, that's going to be the biggest part of tomorrow in price action. What did Jerome Powell say? Everybody digesting that information and thinking, what do we make of it, right? Well, we'll digest it now, and we have been. So we get weekly claims, as we normally do every week. The expectation is 222,000. Last week, it was a little bit lower than expected at 217,000. Continuing claims, last week, it was at 1.438 million. And then we also get the September trade balance tomorrow. Not a big deal, but it's expected to come in at a negative $71 billion. Last month, it was a negative $67.4 billion. And then we get the preliminary Q3 productivity. Expectation is 0.5%, which is a lot better than last month, where it was a negative 4.1%. So that's a big jump. Can we get to that 0.5% growth there? And then the preliminary Q3 unit labor cost. The expectation is 4.2%, which is a big deduction from the prior reading of 10.2%. Okay, let's go through the main indexes here. Let's open the charts up and let's talk about expectations, price points that we need to be aware of. Today in the Discord, it was actually kind of interesting. We were talking about trades that were taking place live, which was pretty darn cool, I must say. Okay, so on the SPX here, you can see the purple lines on the chart. That's the weekly expected move. So today, we broke through the bottom end of the weekly expected move. Now, the weekly expected move down there is 37.83. Now, in a normal setting where we don't have the FOMC butting into price action, typically when we come outside of the weekly expected moves, you can see us come right back into them by the end of the week. I'm not so sure that's going to happen because of what Jerome Powell said today, right? Rates are going higher than expected. That's the big message to take away. Rates are going higher than expected from their September meeting, which was their last meeting. I know I keep saying it, but it's a big, big deal. So this price point down here where these anchored VWAPs are, that will be an important place to watch for the SPX. And right now, that's sitting at about 37.20. 37.20. So watch that for a potential bounce there. If this gets broken through 37.20, then we've got a little more ways that we could go and fall. The first place that I would look is right here. And that price point for the SPX is 36.40. So make sure to write these numbers down. If we're going to continue falling, these will be important numbers. So again, I'm going to write them down here too. The first one is 37.20. Watch that for support. And then the next area is going to be 3640. Those are two very important price points to watch for the SPX for a potential bounce. Now, if we do get a bounce, watch out for resistance at 3,800. If you look back here, this bottom, this bottom, this bottom on these candles, they're all right around 3,800 to 3,810. That would be an area of resistance on the 5-minute chart and even on the 1-minute chart when I was watching this afternoon. It got to that 3,800 level. It acted as support, but eventually it fell through and it just broke it, and it did not return. So watch that for resistance. 3,800 for resistance on the way back up. All right, clean this up. Let's go to the SPY, and let's talk about expectations here and price points to watch out. All right, the SPY. Get the weekly expected moves on here. All right, there we go. You can see same thing as the SPX, broke through the weekly expected move, which is 377. You can watch that as a price point. And then we have this other price point at 380. 380 will also be a critical area. It will probably turn into resistance. It was support. Let's just open this up here a little bit. Right here at 380. That's going to be a potential resistance area if we do happen to get a bounce. Now we have this quarterly anchored VWAP coming out right here, just below that, and that's at 372, which we're not far away. 374 is where we are now. So 372 would be the next area, and then the biggest one would probably be around this 365. That would be a bigger area that I think support and buyers would really step in at. And over here on the volume shelf profile to the left side of the chart, that's where the biggest candle is sticking out, right there. And again, that's at 365. If I open this up and look at the numbers, I got to move this over a little bit so I can see. That price point. Okay. That price point, we got 12.4 million buyers versus 13.5 million sellers in that 365 area. So that is pretty substantial. Total number, what is that? 26 million there. At that price point alone, out of what is total volume today? Where's total volume? 126, 100, call it 127 million on volume today. So it's a big chunk, but still it doesn't make up the whole chunk. And our average volume is at 97.7 million. So pretty big difference there. There was a lot of volume today. So that's the SPY. Let's go over here to the Qs and check this out. This chart load, get our weeklies up there. Right now, for the Qs, we're actually in a support area, and it's a pretty big support area, but we need to nail this down a little bit further. If you look here on the left-hand side, I'm going to draw this line for the volume shelf profile. It comes out and peaks right here, right about 275, and then it starts to go back, but then it really breaks down at this point right here before breaking down really hard from there. So if we're looking for support zones, we're going to have to look at these past candles right here in this zone. There was a lot of support, a lot of resistance, and we are just about at that point. It's about 266 or so. So that 265, where we are right now for the Qs, is an important area. If 265 for the Qs cannot be held, if there's not a bounce here and it can't be held, then we're going to go retest the low. Okay. And that low, just as a reminder, was at 254. 254 was that low. So if we can't get support here at 265, where we are right now on the Qs, unfortunately, that's the next place on the chart. Really. Maybe there's a little bit of nibbling right here at about the 262 area, but it's not a whole lot. It really isn't. And then it just drops off. Maybe we're going to be retesting the low of the year for the NASDAQ and for the Qs in the next coming sessions, if we cannot hold it together here at 265. So that's very important to note. And I'm going to write that down for the Qs. 265 needs to be held. If not, new low. Okay, got that. Any questions on the Qs? It's not looking productive at all for the Qs here, unfortunately. And if the Qs do go lower, watch out, because we could seriously retest the lows for the year down there. If I were to draw a box, sorry, wrong one. If I were to draw a box, I would probably take it about here, open it up, and I would drop it down to about right here. This would be the chop box, right? Where we've been chopping around going back to September. So the past couple of months, that's the chop box. Obviously, you've got the low of the year right there in the middle, kind of like how oil did. And now we're coming back down. We fell out of that chop box. Can we get support where we are? It's looking pretty shady. Like, not so sure. Not so sure about that one. All right. Do you know what happened to SoFi? Yeah, great news. SoFi had awesome earnings. Do you know what happened to SoFi these last 2 days? SoFi had great earnings. You said it got destroyed? Let me pull the let me pull up SoFi here real quick, and then we'll go to IWM and MDY, the small caps and mid caps. Small caps have been holding up the best out of everything. SoFi had great. Oh yeah, okay. SoFi, it's a bit of a momentum stock. And if I do this, let me show you this real quick. Let's see here. Where is it? Oh, what was it called? What was it called? Oh, that's right. Top stonks. Right? Top stonks. Let me bring this over here to you. SoFi can fall into the category of meme stock. Unfortunately. So that's your Wall Street Bets, 4chan, Twitch, etc. SoFi can fall into that category. And if we look here, these are the most mentions, and you've got SoFi right here on this board. That's what happened to SoFi. SoFi had excellent earnings really, really, really good earnings, making me very confident in SoFi's future. So what did that do? That caught the attention of the Wall Street Bets crowd, and I don't know how to describe the crowd, but it caught their attention because SoFi can be a meme stock. I don't know what else to call it at times. And that's why SoFi went up really big and then crashed really big, because all of that, all that money, all of those call options, they got profits taken, and SoFi just, man, that's unfortunate because they had awesome earnings, but I did not notice today's dramatic fall. Some of today's dramatic fall did have to do with the Fed's actions, because as rates go up, borrowing money becomes more expensive. That hurts smaller companies that have to borrow money. But SoFi, they had great earnings, and they're not going to need to borrow as much money as some of these other smaller cap companies. Then you combine that with the fact that SoFi can become a meme stock, and it can be a disaster at times. It can also be very thrilling at times as well. So that's what happened today with SoFi, and that's what happened yesterday with SoFi. Yesterday, great earnings. Today, the Fed plus meme stock. Now, if you want to track this, here it's top stonks. It's spelled with an N instead of a K, but here I'll put it into the comments. If you want to track them, you can, and obviously the most mentioned names are going to get the biggest moves when it comes to Wall Street Bets and stuff. So they're tracking at the top here, Wall Street Bets, 4chan, and Twitch for mentions of stocks, right? They've got the heat map right here for bullish and bearish. So the SPY, very bullish, surprisingly. That was probably the middle of the day. Just scrolling down here. It's an interesting website, and they've got crypto too. But you can use this for data, right? If you're looking for trades, this is a place that you can look and see, what's the younger generation thinking? Where are they going, right? What are they talking about? This is a cool website to do that. So unfortunately, SoFi fell into that crowd, because when you look at the IWM, let's go there next. It did have a punishing day. Let's see here. Take that. It got destroyed, down 10%. Last I saw was negative 5%. Okay, yeah, I'm all caught up with your comments there. So I do apologize. I did not look at SoFi today, and I didn't know that it fell so much. I just know that they reported awesome earnings, but man, even that can't hold up. All right, let's go to the IWM here. And I'm glad I gave you guys that website to look at too, because that's just another place where you can get data to help with your trades. Okay, IWM, it has been performing the best, or it's been performing relatively really, really well, all the way up until nearly touching its 200-day moving average, almost like the Dow. But if we go back here, you can see on the volume shelf profile, this point right here, that's where it stopped. All right. That's where it stopped. And the volume shelf profile just kind of falls off at that point. So when you're on the way up and the volume shelf profile says, oh, hold up, volume really falls off when we get to these price points, that's when you can say, oh, well, there's not going to be buyers stepping in, and you can play a fade on that one, right? So the volume show profile does help you with these situations. So now that it's falling, look at the volume show profile now. Once we get to this point right here, almost the weekly expected move, there's a huge air gap there where volume is like nowhere. It's like gone. And that means that as it's falling and this air gap here, once it starts falling and it gets to the air gap, it just rushes right through that air gap and falls even quicker. So if we break, the weekly expected move, or where we are right now at about 175, I'll put that down here for the IWM, 175. If we break below 175, watch out. We're going to take out the weekly expected move, and we're going to easily fall a couple of points there before volume picks back up again. So watch that 175 area for some kind of support. If we do not get it, and again, the weekly expected move is at 176. So call it a zone between 176 and 175. But if we don't get held up right there, unfortunately, it looks like we could go a bit further here. The next area would probably be about right here, because it catches several candles as resistance, and it caught some as support right there. And that's at about the 172. Below that, we're going to go all the way down to 170 before finding any support whatsoever. So I know it doesn't sound like a lot. We're talking about 176, 175, 170, 172. It's just like $5, right? $5 or $6 that we're talking about. But that's where the zones are for the IWM. So if it breaks through 170, it's gone. And it'll probably go down and take out the low for the year. So 170 is like it. 170. Breaks 170, and it's probably going down to new lows for the year. So a couple of price points there where we could get a potential bounce, but I don't know. It's not looking so likely that we're going to get that type of a bounce. All right, let me just clean this chart up here a little bit, and we'll go to MDY. I'm throwing that in now to the mix because that's your mid caps. One more. Okay, MDY, that is your mid cap companies. And you can see, relatively, they've been performing really well in this rally that we've been in. And today, they actually held up pretty darn well. So this is looking pretty good for the MDY as a potential support area. And it's not a very big, $24.99 is where it is a share right now. Not that much. But if it can hold that 25, 24 type of zone right there, it'll stay. But if it breaks that, then we're going to go down here to the 22.7, 22.5. That'll be the next area, maybe even at the 200-day moving average, which is 23.2. So make it a zone there. 23.2 down to 22.7 as a zone. If it gets broke here at about the 24 to 25 area. So watch that. And that's the MDY. Now, some of you may be playing this in a little different fashion. Today, let me hop over here. SPXS. Add that one extra letter, and you get the direction daily S&P 500. This is a leveraged vehicle that you can use if you want to short the S&P 500. This is where I was today for the ride. This was up 7.44% on the day. It did kind of tap out here at its 50-day moving average, closed just slightly above it. It's right about 24.58. It's about 10 cents above its 50-day moving average here, which is a significant area. If I draw a line across here capturing those other candles, this is a significant area. Now, if the S&P tomorrow wants to continue downward pressure, which is a likelihood, there's a good probability for it. The one thing you have to be careful is with today being down 2.5% on the SPX, 2.5% on the SPY, 3.5% on the Qs, 3.3% on the IWM, there may be a bid first thing tomorrow morning, causing a spike before a potential sell-off slow and through the remainder of the day. That's a potential probability for tomorrow, that we do catch a bid in the morning before selling off the rest of the day. All right. I don't know how high of a probability that is, but it is a probability. Now, if the S&P, the SPY, if it wants to go lower tomorrow, then the next real big area here is going to be a zone that's going to come in. It's going to catch these candles right here, which is at about $26.50 up to $28. All right. SPXS. Where's that price point at again? Right there. $26.50 to $28 as a potential. If the S&P wants to continue selling off, then that's where it'd probably go. If it broke that zone, then we're probably going to a new all-time low on the SPY, and then of course not an all-time low, you know what I'm saying, a new low for the year. Then we go for a new high for the year on the SPXS. All right. Now, if you think it's going long, you can go SPXL, which is a leveraged vehicle 3 times. And if you think the S&P 500 is in a bullish setup, then you can hop over here and you can ride it. But just as quickly as you can make money, you can lose money just as quick if you're not careful. All right. This was down 7.5% on the day, where the SPXS was up 7.4. So you do have to be a little bit careful when you are in these vehicles. Okay, that is everything that I wanted to cover today. Do me a favor real quick. Click that like button. Share this video with a friend. And if you like the perspective, click the first link in the description. And that'll wrap it up. All right, I'll give you a minute if you have any other questions for today. Otherwise, get ready for tomorrow. Volatility is here. Just to recap real quick, if you do have any questions, to give you a moment. The Fed is going to tighten, and it's going to raise rates higher than it anticipated in September, which was their last meeting. So we're going, instead of 4 to 4.5%, now we're going to go to 4.5 to 5% by Q1 of 2023. That means no pivot. That means no pause. And it means a potential slowdown maybe in January. As a matter of fact, just real quick before we do cut this out, let me go to CME FedWatch tool. I should have probably opened today with this site loaded and ready to go so we could look at December. Okay. We got our 75 basis point rate hike, just like we were expecting. Let's see here. While this website is loading for us. Do you think rallies are shortable until CPI? That's a great question right there. Will CPI come down? Well, look at this. This is interesting. Make sure I'm here. For the December meeting, before I answer that question, for the December meeting, right now, we are looking at a 50 basis point rate hike with a 61.5% probability and a 38.5% probability of a 75 basis point rate hike. So right now, the market is saying that we're kind of leaning towards a 50 basis point rate hike in December. We might get that. Now, if we look at the history here real quick, that 61.5% for a 50 basis point rate hike at the December 14th meeting, that 61.5% probability was a 44.5% probability yesterday. So that's interesting. That's interesting that this has gone up. And I can remember Jerome Powell saying that it may not come next month. It may come the following month, which actually wouldn't be January. It would be February the 1st. So if we go out to February the 1st and we look here, we're at a 52.8% probability of a 50 basis point rate hike. Where was that yesterday, I wonder? It was at 47% yesterday, and now it's at a 52.8. So it looks like the market is trying to say that we'll get a 50 basis point rate hike in December and a 50 basis point rate hike on February the 1st of 2023. And that would give us our 1% boost from where we currently are. And that would take us to 4.75% to 5%. That's how we get to that 5% number. And that's what the market is looking like. It's thinking the Fed is going to do. Okay, do you think rallies are shortable until CPI? That's interesting. I do think this market does have more room that it can fall, but it's also at critical support levels. As I pointed out on several of the indices here, they are at support right now. So if they break the support that they're sitting on right now, they've got lower to go. However, there is that probability that we could see a bounce from here. Like I said a few moments ago, don't be surprised if you wake up tomorrow and find that the market caught a bid and gapped up from the levels that we're at right now. Because this is big time 2.5% for the S&P 500 in a day. That's a pretty big move. And sometimes they're followed up by green days before just selling off, right? If we go back here and look at a big red day, let's just take the last big one that we had, and that would be on October the 14th. The very next day, we gapped up in the morning. So that's a possibility. We can go back here to September the 27th. We gapped up in the morning before selling off for the next 2 days and hitting a new low for the year. So that's interesting. If we go back to the last FOMC meeting, September the 21st, that was a 1.7% fall for the S&P 500, but we fell pretty hard for the next several days in a row, leading to a new low for the year, I don't know, about 6 or 7 sessions later. So I'm having a hard time answering that question because, yes, I do believe that the market can go lower. I am in a short right now. I carried it over from today through till tomorrow. So I believe that there is more that the market can give up. But looking at the technical analysis here, the market is at key levels of support that can catch a bid. So the market has got to digest what the Fed said today. So we could also see a volatile market that moves sideways, slightly lower, slightly higher over the next few days. It's a tough one to call. I'll be honest, because this rally right here, okay, I missed it on the cues. Let me go and pull the cues up here. I got it wrong on the cues, and that had to do solely with earnings. And that's why I missed it on the cues. I thought during this rally, since the cues were underperforming relative to the S&P 500 during this period right here, I thought that there was more room for the cues, and this was back here, to at least go up and tag the 50-day moving average. And that didn't happen. It sold off. So I have this wound right here fresh in my mind as a mistake that I made, which is making me a little bit second guess myself when it comes to this question, because I'm seeing two things. I'm seeing the market reacting to a more hawkish Fed than the market anticipated. And I'm looking at technical analysis here telling me that there's key support either right now or just a few points away for some of these products. So I do apologize for kind of being wishy-washy on your question here. Okay. I'm just trying to be honest about it. I'm torn because I've got that fresh wound from the cues that's making me second guess. I'm seeing technical support for several of these products. I see the 10-year and the 2-year as possibly having more room to go up. That's going to put pressure on equities. So that's something else that, let's put these puzzle pieces out there so we can put them together. The Fed was more hawkish than anticipated. Check. The 10-year and the 2-year, they have more room to rise. They are not at resistance yet. If they go up, that'll put downward pressure on equities. Looking at the US dollar, it is at a very key level right here of prior resistance. If the dollar can break this resistance and go up, and there's nothing out there saying that it can't, it very well could. A dollar going up is also going to put pressure on equities to go down. However, the dollar could, let me get my highlighter here to show you. With the dollar at resistance, okay, if it can't break it, then it's going to come back down here to this support line. And then this resistance line here is going to continue, even though my line's not straight, it'll continue straight, where the dollar is going to be forced to either break through it or break down. So we've got a lot of moving parts here that are at critical levels right now. I think that's the main message that I want you all to have. We're at critical levels for all of these different moving parts, right? So we've got to pay close attention to how the market is going to digest and react to this information. I would say Rallies are shortable until CPI not all the way. We have to see where the dollar is going. That's going to be very important. The dollar is not weakening, okay? If we open this up, and let me do this so you can see. Look at how strong the dollar's been. You all know it. We talk about it frequently. A strong dollar means poor earnings, and it means a weakening equity market. That's what a strong dollar does. And this strong dollar, unfortunately, or not unfortunately, depending on how you look at it, this could play a big role in how equities are going to react. And I apologize for sounding wishy-washy on this answer. So I'm going to leave it at there's a lot of moving pieces. We need to watch how the market digests this information. Don't force a trade. Wait for your trade to set up. Wait for these moving pieces to get into a better position. I don't think now is the perfect time to short. You know the old saying, don't short in a hole. We made a hole today, and you don't want to short from that position. You want to short from a stronger position. When the market is at resistance, that's when you short. You don't short when the market is at support. And I just see too many pieces right here that are too close to support areas that could hold. Okay? The narrative tomorrow can really quickly flip to the Fed is going to slow down next month, which can very easily be turned into clickbait that the Fed is going to pause. And that could be the narrative tomorrow, that the Fed will pause, causing the market to bounce off of these areas, off of these levels. So it's an interesting point where we are right now. Yeah, maybe a retest to 38. 38 is a critical level for the S&P 500. Absolutely. It was critical even today. Let me real quick, I'm going to go to the 5-minute chart here to show you how price action reacted today around that 3,800 level. It acted as support before acting as resistance. So let me put a line here at 3,800, which is right here. If you look, 2 candles right there, bounced off of 3,800, support at 3,800 right there, and then resistance at 3,800. 3,800 to 3,810. That's the zone, the wiggle room. 3,800 to 3,810. If we do catch a bid, if that's the play that we're going to make here, if that's the way the market's going, we could catch a bid up to that 3,800 and maybe find resistance there, and that would be the time to short. Because also keep in mind of where the weekly expected move is, and look at how it acted as a magnet today on the 5-minute chart, okay? The weekly expected move acted as resistance, holding price action right there. You can see it right here. 5, 10, 15, 20 minutes. It held as resistance right there before breaking through. I believe it was 37.75. That's where I added to the short position, because I figured once it broke that 37.75, it would go lower. It did go lower. And now I'm kind of watching the weekly expected move. And like you said, 3,800. That's critical. All right. So don't short from here. All right. The setup is not there to short right now. Right now, the play is to be patient and watch how the market reacts around these key levels, how the market digests this information. What are they going to say as the narrative on mainstream media to push it out to retail investors? How is that going to play, right? I have no idea, but we'll find out in just a few hours tomorrow. Let's see here. Let me pull this one up here. How would that happen if Powell was so hawkish today? A few moments ago, I mentioned this. Powell was very hawkish today, right? The market fell. The market fell 2.5%, 3.5%. We are at key levels of support. What could easily be taken as a narrative push tomorrow is that the Fed is going to pause. Even though we know the Fed is not going to pause, the Fed is going to slow down its rate hikes. It's going to go from 75 this month to maybe 50 in December and then 50 on February 1st. That's a possibility that would get us to that 5% mark by Q1 of 23. But the narrative tomorrow could be the Fed is going to pause. They could take this and use what Fed Chair Powell said today and say, yep, we're going to pause soon, meaning February could be the last rate hike, could be, and that would be the pause. So saying that the Fed is going to pause soon, getting market participants overly excited, isn't that far from the truth. So that's how. All we need is the mainstream media to come out and say, the Fed's going to pause soon. That's the takeaway. The Fed is going to pause soon. And you would have all kinds of investors and market participants getting happy. And like I said, it's not that far from the truth. February 1st, the last rate hike potentially, and then it holds there. And that's another key fact right there that market participants aren't taking into account. And you have to remember, too, that the market's not logical. The market is emotional. And the market rallying, look, this is the 5-minute chart right here. At 2 p.m., the market spikes. The market goes up. They get the press release and they hear the word lag being used for the first time, and they take that as good news. It's emotional. So you can't think of how could that happen if Powell was so hawkish today as a use it as a logical question, right? That question is going to get an emotional answer because that's what the market is doing right now. It's being emotional. And the market always overreacts, right? So we have that probability that we're at these key technical levels or not far from them, that we could catch a bid, even though Jerome Powell was so hawkish today. I believe he was hawkish. He did use the word lag for the first time, which you could use that as a dovish term, but he also said, we're going to raise rates higher than we thought from September. And that was their last meeting back on September the 21st. So now instead of 4 to 4.5%, we're going 4.5 to 5%. And we can easily get there. So that's my best answer, is that this is a logical question right here, but the market is not logical right now. It's emotional. So we do have to watch the key levels that we're at. Okay. All right. Any other questions? Any other questions? It's important to watch the key levels, all the ones that we talked about. SPX 3720 could catch a bid at 3720. 3800 could be resistance. We have to watch that. For the SPY, it's 372. That's where we could catch a bid. It's possible. But it could break from there, so have to watch that point. For the Qs are at support right now at 265. If 265 cannot be held, then we could be going and reaching a new low for the year on the Qs. For the IWM, 175, it is at its support level right now. For the MDY, mid caps, we're looking maybe 23.2 to 22.7 as a potential zone. That could be what happens. All right, let's this one up here. Yeah, this market wants to hear what it wants to hear. Perfect, perfect, absolutely perfect. You're absolutely correct. Absolutely. And if we were to go back to September the 21st, maybe I can do that here on the 15-minute chart. The market acted the same way. All right, let's see here. All right, there's the 21st, right? No, that's October. 21st of September. Okay. I'm gonna go back to the 21st of September. Let me put this one up here. What do you expect for tomorrow? Down more. Okay. We are really close to key levels. Okay. We have to be mindful of these. For the SPX, write these numbers down. 3720. That could be support. 3720. 3800 could be resistance. Watch those. Also watch the weekly expected move. If 3720 gets broke, then it's 3640. Watch that. For the SPY, it's 372 down, and then the next area would be 365. So watch that for support. For the Qs are sitting at support right now, 265. If 265 is broke, then we could go to new lows for the Qs. Same thing with the IWM. It's at support, 175. If that's broken, then we could go to new lows for the year. All right, I have finally arrived at September the 21st, and let's just remind ourselves of what happened back then, okay? And let's open it up, almost there. You can see the bigger candles there. And what happened? All right, let's open this up a little bit here. Okay. All right. The 21st, last FOMC meeting, we had this big fall when the press release came out, and then we rallied right back up, right? You see that? Down, and then boom, right back up. It was later in the afternoon, we had the slow sell-off, okay, before moving sideways the next day. And then look at that. We just moved sideways the entire day. And then we finally gapped down the next day. The market had to digest and think about, what did the Fed actually say? So this is the 21st of September. The day ends right here. The new day begins. And then we get over here where the day ends, the new day begins at a gap down. But that next day, we went nowhere. Nowhere. Chopped around the entire day. That's what we could do tomorrow, since we are at key levels right now. The Qs at support 265, IWM at support 175. We could move sideways tomorrow like we did on September the 22nd. Okay? Or we could go to these other levels that I mentioned for the SPY, for the SPX, and test support at those places. And if we catch a bid, it may not last. You are very welcome. Absolutely welcome. It's always hard to say what's going to happen the next day after a big news day, right? After a big day with a lot of data. Today, one of those days. The Fed came out, they raised interest rates, they talked about the future. Now the market has to digest that information. They have to learn, what can we glean from it? What can we learn from this? And then make our decisions off of that. It's all emotional. It is not logical right now. Keep that in mind. Play it safe. You don't have to trade tomorrow. Okay? Wait for the trade to set up. Wait for the trade to come to you. Don't force a trade that's not there. All right. Well, I believe that is it. I love your questions. Absolutely love them. Click that like button, share this video with a friend, and click the first link in the description to join us on this amazing journey. Thank you very much. I am had a bug going around the house, and it finally caught me. But glad it didn't last too long. All right. Well, we'll wrap it up here. Thank you, ladies and gentlemen, for joining me. I greatly appreciate each and every one of you for spending your time here asking these questions. I love them. I'll be back tomorrow after the market closed to talk about what happened, why it happened, and what to expect moving forward. The eventual route is, oh, I like this one. You are true. This is a true statement. The eventual route is up. Just DCA, dollar cost average, and watch. Make sure you get, oh, yeah, I'm good. I don't. That's not, I don't got that. Nope. All good with on that front. All right. You are welcome. And thank you for saying that, because there is truth to that. We are, I believe, close to a bottom for 2022. We may have already touched the bottom for 2022. So make a list of all of the companies you want to invest in over the next 5, 10, 20 years. Make that list. Set price points for where you want to enter. Set aside a little bit each month and enter each month a little bit to the companies that you love. Start with the companies, a real simple fact. Start with the companies that you buy from on a daily, weekly, monthly basis that you like. Invest in those companies first because you understand them. You own their products, you like their products or services, whatever it may be. Start there. Start small. You can do it. It's not too difficult, but we're here if it is. All right. Thank you, ladies and gentlemen. I greatly appreciate it. And I'll see you tomorrow after the market has closed, and we'll talk about this all over again. So thank you, and I'll see you in the next video.